Welcome to the dark side.
All right, guys, next up, we're going to talk about risk management for getting short. Basically, okay, how and where do I get short? How much should I actually get short based on my portfolio size? So essentially, what I'm going to say here right now is that whatever position size you're typically going long, you should about half that when you're going short, because I promise you're going to get yourself into some extremely sticky situations going short. Shorting is so fucking dangerous if you don't do it correctly, and if you don't use stops, and if you get over leveraged in going short or do too big a position size, I promise you're going to lose a shitload of money. The smaller positions you take going short, I promise the better trades you're going to make. You're much better off not trying to go for some big home run win, going balls deep short and sticking to smaller positions. And rather than just not making any money when things are collapsing or trying to go short, at least start making some money going short, as opposed to getting all of a sudden just annihilated because you leveraged going short. So say if you had a $10,000 portfolio and you were using 10% per position going long, so you're using $1,000. What you should do from that point in a stance of going short is only use 5%, right? Half of the size that you're using for going long, you would want to use 5%, which would be about $500 for going short per position, because you want to reduce the risk and we want to reduce losses, because especially if this is your first time shorting, it's going to be scary. It's going to be difficult. You don't want to blow your account up just because, like I said in the beginning, there's infinite loss potential. Obviously, your broker will stop you out and margin call you, but it's very easy to lose money, especially if you're using leverage, which I don't recommend you use leverage at all. Obviously, if you're trading short, you're typically going to be trading futures, and you have the option to do 100x leverage, which is completely idiotic. And sometimes I use 1 to 5, not so that I can take massive positions, but just so that if I find a short trade opportunity, say I have $100,000 in my futures account and I want to get short $50,000 on a position such as like Bitcoin or something, I don't want to go all cash $50,000. That means I just gave up half my futures account, but I can maybe do 5x leverage and only use about 20% of that $100,000 to get a $50,000 position. Not that I don't have $50,000 in my account. I'm just using it. Okay, what if there's other coins that I want to short also? And then I can split that $100,000 up a little bit easier than only having $50,000 in that account, which is risky because that's overdoing the percentage wise of it. But Bitcoin is a little bit different. It moves slower, so I might have a larger size. At the end of the day, using any sort of leverage is extremely dangerous. You're asking for trouble. So anything you can do to reduce your size, especially in the beginning, that's what you should be doing. Another thing for entries on going short is typically you're never going to go, okay, it's time to get short. This is going to be my one entry point and that's it. You're probably going to want to have at least 2 to 4 entry points going short, meaning giving you different options to get short, because we never know when that top is. And for an example here, say if you were using a $500 position to get short, you might not actually use the full $500 because you don't get the opportunity. So say if you were going to have 4 potential entries based on a supply zone that you're getting into, one, which would be the lower range, the lower wicks of the candle, the base range, which is the body of the candle, the upper range, which is the upper extension of the candle, and then the AFZ, fuck zone, right? The last entry before we potentially stop out of this position. Because if it all of a sudden spikes massively over this position, it could be on a trajectory to blow up to the next zone, which who knows how it was. What if that's, 20% higher? We don't want to get stuck in a position where we're all of a sudden 20% loss when we're trying to get in at this zone and call the top. But as always, we want to have at least a little bit of breathing room. It's hard to say how much you want to put this. You're just going to have to figure it out and play with it as you learn how to short, because what do we want to find out here? We want to potentially not get stopped out and potentially take advantage of bull traps, right? Because we love bull traps, because when the bull traps actually trigger, price action might come back up into this zone, retest all the upper ranges, and just go one last spike up above into the AFC, and then bulls thinking they're going to the next level, which sometimes they do, which is why you have to have a fucking stop loss here. If it fails to break this out and actually reverses, that's when you see an accelerated, very fast reversal, and all of a sudden a lot of panic selling coming, and that's where we can take advantage of, a 10 to 30% drop really quick, likely into, the 9, 13, and 20 EMA zones if you're going longer, which we'll talk about next, the actual full reversal, right? So that would be an example of getting short with one. The other one is a tiered system where your biggest position is up in the AFZ, right? Because I say down here, pro tip, cancel your first entry point idea. It's usually shit and wrong and caused by FOMO. A lot of times we'll be in a position, not actually in a position yet, but we see price action coming up into the potential zone up here, but rather than waiting for it to get up there, we're getting FOMO and we're like, well, what if it never gets up there? I don't want to miss out on this. I have FOMO. We start entering down here here, getting in short down here before it's even in the zone because you get anxious, or it goes right into the lower range. Say if you have a $500 position, you take $500 down here. And rather than having any cash to enter in the AFZ, you're stopping out in the AFZ rather than being comfortable because you tiered it or had a multiple entry opportunity to take advantage of this. You got impatient and FOMO because you're thinking, well, what if this is the top? What if I miss it and it doesn't go up that high, right? And this happened to me many times. Okay. So I've done this 500 times. Okay. So I'm saying this out of experience myself and something you're probably going to experience as well. So typically, if you're doing a tiered system for entry, you want your smallest positions to be in the lower range, middle ground for the base range, then step it up higher for the upper range. And then in the AFZ, your largest position. So that way you're not taking a massive loss if you're stopping out over the AFZ zone, right? The highest risk reward here is your biggest position, which also is right at the cusp of potentially stopping out here. All right. So your stop loss level when you're getting into the AFZ zone is pretty fucking close, where you might just get in with the last position on the AFZ and then 5 minutes later you get fucking stopped out. You're like, fuck. But that's better than tiering this or getting $500 down here, and then you just took a negative 10% loss on $500 right here, as opposed to maybe if you were in this tiered system, you might only lose 4% as opposed to 10 because you went balls deep down in the lower range, right? So typically, pro tip, cancel your first entry. Don't even try to get in the lower range. You might miss some trades, but in the long run, you're better off sticking to the AFZ in the upper range for the sizable portion of your position. So that's essentially, in a nutshell, how I would suggest getting into your short positions.
Welcome to the dark side.
All right, guys, next up is risk management for taking profits. Now, when entering shorts on top reversals, which is mostly what we talk about in this program, the 9, 13, and 20 EMA is a super strong support zone when buyers come in, and they usually buy the dip, especially in a bull short-term trend. So this is a primary area that you want to lock in gains for the majority of your trades. Say if we are getting into a trade here, here's the supply zone, here's the upper range. Say if you got short here in the upper zone and the AFZ. So when would you start wanting to take short profits on this, right? You would want to wait, and then hopefully your reversal actually works out, and then it turns into a bull trap. BT, if it did hit into the AFC and was above this range here. In the 9, 13, and 20 EMA, you're going to want to start locking in maybe the majority of your gains down here, right? Because as we've seen many times before, anytime markets in a bull trend, where do things buy? Where do people buy the dip? Right around the 9, 13, and 20 EMA. Even if you're, shorting into a supply zone here, where do people buy the dip? 9, 13, and 20, 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 until it finally reversed, right? And so a lot of times we get greedy and want to take advantage of that 9, 13, and 20 breakdown to the downside, but probably on 80 to 90% of the short trades that you actually take, it's not going to flip that reversal trend, and you're going to wish you locked in maybe all your gains on the 9, 13, and 20 in that range, because that's where people buy the dip. Okay, so this is the zone that you're going to want to be locking in profits. When you get into a supply zone, people start locking in profits, then the market reverses on this actual particular asset and then bounces off the 13, 9, and 20 EMA zones. So that is the primary objective of locking in your profits, because a lot of times what happens, buys the dip, boom, you got a nice perfect short. Maybe you took advantage of negative 20% here to lock in gains. And if you don't lock in these gains, all of a sudden next thing you know, it's breaking back out and you're panicking, freaking out, and you might just stop out for break even, or you put a stop up above the high of day here, and then you stop out here for negative, 10% when you had an awesome 20% short trade on this. So here again, this is what a lot of the greedy big gains trade, what everybody wants and fantasizes about, because this is where big money is made. The problem is a lot of times this never happens unless you time it with, the 50-day moving average breaking down, which a lot of times it doesn't. Okay. So this is very difficult, but it can happen. You can make massive fucking gains if you have the patience, but you're going to give up a lot of gains over the long haul by not locking in profits. So as I was saying there, guys, the majority of time, you're going to want to lock in your gains at the 9, 13, and 20 if you want to keep a portion for the potential greedy big gains trade for that reversal, which a lot of times, majority of the time, you're not going to hit it, but that is where the big gains are made. But I almost never catch this. I usually regret almost every time I don't lock in my gains down here, because then I get fucking stopped out here, and then price action just absolutely pumps to the upside. So let's just take a look at the profit targets that we typically look for when we are actually short. One is the 9, 13, and 20 EMA zones, right? So if we got short in a supply zone up here, SZ, right? We want to lock in profits here. Then there's also the potential area of, maybe we did catch the flip on the reversal, or, maybe there's this demand zone somewhere at the 9 EMA up here, and so there's a demand zone from a previous candlestick back here, right? And then we're greedy, thinking, well, what if it drops to the 20, but there's also this demand zone that we can previously draw, and it's only at the 9, right? So rather than getting greedy and waiting for the 20, maybe this is an area where it's very, very strong support now, and we just want to take the whole entire profit right here. All right, so that's another addition of, we want to look at demand zones that are previous in addition to the 9, 13, and 20 EMA zones, but maybe there's other demand zones that we can look at that are going to give us a better idea to whether lock it in right at the 9 or try to have some more sort of patience, because maybe there's a demand zone at the 20, and that would be looking like a better opportunity to lock in, maybe a portion of it here and then wait for the next level and maybe a portion of it down here. Just like we're entering multiple times, potentially you want to exit multiple times, because if you want to get the biggest gains, you have to have patience and you can't just lock in on the first profit target that comes your way. The next thing is hold numbers. Again, initially, the first thing we're always looking for is the 9, 13, and 20. But maybe there's a whole number somewhere of significance. Say if it broke down the 9, 13, and 20 EMA, maybe this is at 7, but maybe there's $6 here in a demand zone, but there's also 5 right below it. So we want to look at all these different things when we're trying to have patience for the bigger gains, of which I don't typically recommend always going for big gains. When you're trying to go in for big gains to get short, you're going to get stopped out, you're going to get squeezed, you're going to get burned many, many times. So I rarely recommend going for these big gains. For the most part, when you're taking profits on going short of a reversal, lock in the majority of your gains in the 9, 13, and 20. If you want to go for the bigger gain and look for that reversal, of which you might see a massive fucking dump to the downside, then look for demand zones, look for whole numbers to start locking your profits. Just like when Ethereum flipped over the 13, 9, and 20 here, we're now seeing these massive drops. Lock in your profits, the majority at the 9, 13, and 20.
Welcome to the dark side.
All right, guys, next topic of discussion is never short oversold breakdowns. It's very tempting when you see, support levels break down and you're thinking, oh, we're going for the next leg down. Let's short more here, whether you got up here and here and here short, and then you're thinking, it's going to break down. It's about to wash out. Let's get short more, or have my first entry short down here on the breakdown. Never a good idea, especially in the crypto market. The majority of the time, a lot of the times, the breakdowns are quickly bought up and they turn into what we call a bear trap. Remember, we talked about bull traps. So I never recommend shorting into these. If anything, a lot of times these are buy signals, which then things reverse and you see a massive move to the upside. And so it's the same exact patterns that we saw and I discussed over here. We have bull traps on a breakout, one last spike on a parabolic move to the upside, blow off tops to the upside where it's one last run up and then a huge reversal to the bottom, or a double top. This could also be a double bottom. So the same exact patterns that I talk about in the bull scenario for getting short, it's also very dangerous for people who are wanting to short, like, oh, the low's broke, let's short sell, okay? Or we're even stopping out of our longs when this should be a potential buy area for us. Now, this isn't a 100% fact that this happens every time, but every time I've tried to short any negative momentum in crypto, like I said before, when we were doing our risk management, never short anything when it's oversold on the fear and greed indicator. And I promise if it's breaking down on the daily chart, a lot of times it's probably going to be in the fear section on the daily chart as well as the intraday. So never short breakdowns. A lot of times, people are hoping that this breakdown here is going to be the next leg down. And you can see sometimes it does work out like that. It broke down the lows here, broke down the lows here, and then broke down. But you're playing with fire. The risk reward isn't there. You're much better off and you're going to have a lot bigger consistency and heavier profits and smaller losses if you identify the overall pattern that you're trying to go for if you're bearish and get short at a resistance level rather than getting short at a support breakdown, okay? Because shorting breakdowns, just like when a lot of people thought this was getting ready to break down below 30K, nope. Anytime it broke down anything below this level, it just quickly spiked back up, And so for the most part, it's a very bad idea to short support breakdowns, okay? Again, only looking at the daily chart, look for overbought people being way too greedy, look for the supply zone, get short when intraday is overbought and we're in the high greed zones, right? That's when you get short. You don't short when things are breaking down and you're FOMOing into a late trade.
Welcome to the dark side.
All right, guys, final section of Decrypton. Now, this is very relevant because this just happened. No, maybe you're watching this right when I release the course, which is this week, or you're watching this a year from now, but it's actually happening right now. In the crypto market, everything's getting crushed. All the altcoins are currently getting smashed right now, okay? And basically, this is the same thing that happened back here also when the wedge pattern formed up, 50-day moving average broke down, wedge formed up. Same thing that happened back here, 50-day moving average broke down, all the immediate trends broke down. And this basically just, what are the indicators that implicate the beginning of a potential bear trend? First of all, Bitcoin, we saw multiple signals, bear trap, bear trap, bear trap, essentially, and then break down the 9, 20, and 13 EMAs, then break down the 50-day moving average, and then we crossed the 13 and 9 and 20 EMAs below the 50-day moving average, came back up, retested the support on the wedge pattern, as well as retesting, or not the support, the resistance on the wedge, as well as retesting the resistance on the 9, 20, and 13 EMAs here before absolutely annihilating. Now, basically, in order for this to flip around and the bulls to be back in full swing, we need to break out of this wedge pattern that's been forming up here, as well as break above the 9, 13, and 20 and sustain that break. Same exact pattern that we've seen here. We've seen this move time and time again, and you're probably going to see the similar pattern that forms up across all the altcoins. So looking at what my illustration is here, right? Essentially, price action here indicated by the red moving up. This was the, resistance, potentially bear trap that happens by failing to break out over the all-time highs over here. And then 13, 9, and 20 EMA first initially break, right? 9, 13, 20 EMA is all broken. The next is the 50-day moving average breaks. That is like the oh shit moment, like, okay, things are getting very, very sticky now, right? And a lot of times when that happens, we see a massive pullback, and we usually stop out into a supply zone or a demand zone that we did basically coming back down, stopped out, price action, right into these lows, back down here. And that's kind of where things based out. I think we can actually pull this over, right, from our previous supply and demand zones from the past, right? So this is just showing how relevant previous supply and demand zones are into the future. And that's where things based out. Then the wedge pattern was forming up, could have been a potential short right here, getting in on this, and then this massive dip to the downside. Okay, so this is basically what happens when we see a massive bull trend to the upside. And if you see the 9, 13, and 20, an EMA, breakdown, that's first indication. Then the 50-day moving average. It's like, oh shit. After that, you trade the wedge pattern, and that's how you basically get short. If you're inside of the wedge, you can potentially get short into the resistance levels of the wedge or in potential supply and demand zones. If we break out to the upside and you're short of the wedge pattern here, that's basically dangerous news. Cover your shorts, locking your gains, and start looking for revival patterns. But anyways, guys, this is just picture perfect. This exact pattern right here, happening again right here. Same thing happened again right here, and basically happened again right here. That's basically it for Decrypton, guys. Now we're going to get into the actual live trades of me recording past trades that I actually did. Hopefully, now that you guys kind of understand the theory and the things I look for behind shorting, now you'll actually see me implement them in some actual trades, making money, and then hopefully you guys can make some money as well. Anyways, guys, enjoy the live trades. See you around.